Hello everyone and welcome to this April 4th edition of Property Perspective. Today I have the pleasure, as always, to be with Matthieu Arseneau. Hello Matthieu.
Hi Simon.
And with Andrée Desrosiers. Hello Andrée.
Hello Simon.
Our topic of the day, is it better to invest or pay off our mortgage? Before we try to answer that rather complex question, let's discuss with Matthieu about recent economic news that might potentially influence the real estate market. So Matthieu, with the U.S. Federal Reserve talking about interest rate cuts for some time now, is it the time for the Bank of Canada to do the same?
We already discussed that in prior videos, Simon, and of course we think it's time to start at least discussing about it. We just to get a sense of what were the latest data. Growth is resilient, so that's an upside surprise for the Bank of Canada. But on the other side, there's significant improvement in the inflation backdrop. As you can see on the chart that I'm presenting right now, you can see that over the past 2 months, this is a sizable downward surprise for economists. 7 ticks below their expectation in January, in February. That the magnitude you can see, it just happened twice before that over the past 20 years to get that kind of the downward surprise. So, and it's surprising the Bank of Canada as well. And if you look at the detail, so for annual inflation, you can see the blue line, we're now at 2.8%. That's a significant improvement versus the 8% that we were experiencing a couple of quarters ago. But if you look at the details, it's really interesting to know that when you exclude mortgage interest costs, and the cause of the increase is the Bank of Canada itself, if you look at that, we are now at 1.9%, which is slightly below the target of the Bank of Canada. If you exclude just another component, rent, we are at 1.4%. So, in fact, it was successful for the Bank of Canada. They wanted to calm down the inflation, they calmed down the economy, and we can see that it's working with excluding mortgage interest costs and rents, inflation really under control, and it's rather low at this moment. So yes, it opened the door for, we'll see if it's the moment. We are calling for rate cuts for this summer, but perhaps they will put the table that they open for some accommodation in their next decision.
So Matthieu, as you just said, we see inflation going down. But even though some people are still concerned about a possible surge of inflation if we reduce prematurely the rate cuts.
In our view, we are not in that camp for this point of view. I think that there's a risk if they don't do it that the economy will struggle and there's going to be perhaps inflation below target for some time if they are not accommodating enough. Already we are seeing a private sector being negatively hit in the current environment. Over the past 2 quarters, private domestic demand, so consumer investment, is struggling in the current environment. So contraction for 2 consecutive quarters. And if you look at private hiring, in fact, employment is flat since the mid 2023. That's a long soft patch for no hiring at all in the current demographic context. That's very, very surprising. So if it was not from the hiring from government, the labor market will be deteriorating faster than what we're currently seeing. So we have to be very careful, especially that when we look at the issue that the corporations are facing at that moment, that has changed significantly compared to at the moment they start increasing rates. Their main concerns at that moment were cost pressures, labor shortages, supply chain issues. At that moment, and demand or sales back then was not a concern at all. At just on 18% of corporations saying it was a problem, it's now 49% concerns about their potential sales. Labor shortages, no more a concern at all. So that's a big change for me, it's time to give a bit of oxygen to this economy because of this weakness that we're currently observing in the private sector.
Interesting. We saw recently that the government has announced a gradual reduction in the proportion of non-permanent residents by 2027. Is that a good idea?
In fact, I think it's a good step, in the right direction. A couple of weeks ago, we published a report recommending the government to reduce total population growth between 300 and 500,000 a year versus the 1.2 million that we are currently experiencing. That was a sharp decline for population growth that we were suggesting. The main reason housing shortage is acute at that moment. When you look at mortgage payment on a median price home, with the rise in mortgage rates, but no downward pressure on home prices because of this strong demand for housing, we are seeing that affordability is at its worst since the early 80s at the moment. And if people want to look at the other markets, so rental market, we already discussed that. Rents are increasing at around 7-8% over the past few months on a year-over-year basis because rental vacancy rate, as I show on the chart, is at its lowest on record. In that kind of environment, it's really important to calm down housing demand, and I think yes, it's a good decision for the government. Truly, for us, it's not a good idea to bring newcomers in that kind of environment, which is really bad for housing and labor market deteriorating for newcomers as well. So I think it's better to calm down on that front. And it was a bit of surprising to see the latest World Happiness Report that was published a couple of days ago. Good news on one side when you look at the ranking of Canada as a whole. The ranking, we were 15, so in the world, so great performance. But when you look for the younger one, the less than 30 years old, we rank 58. We have a reason to believe that the housing shortage is one of the main reasons for this divergence that we're currently seeing in terms of happiness between. So a big challenge for the for Canada over the next 5 years to resolve this problem of affordability. And I think that what was announced over the past few weeks is a step in the right direction.
Yeah, you're right to mention it, Matthieu. Happiness and economy sometimes go hand in hand. Thank you for your very good comments. So let's now discuss with Andrée to answer the question of the day. Is it better to invest or to pay off the mortgage? So Andrée, some homeowners and obviously mortgage holders might receive in the coming months an inheritance, a salary increase, potentially a tax refund, a bonus, and they ask themselves, what should I do with that money? Should I pay off my mortgage or should I invest? What do you think?
Very, very good question, Simon. While both options have pros and cons, the decision between paying off your mortgage early and investing will depend on your risk tolerance, your financial goals, the market conditions, your mortgage interest rate, and the possible interest yield you may have on your investment. Okay? If your mortgage rate is high, it's more expensive to hold this debt, and it may make more sense to allocate extra cash to pay your mortgage balance to save on your overall interest carrying costs. On the other hand, if your mortgage is relatively low, then it's cheaper to hold this debt while you allocate extra cash in growing your wealth through an investment strategy. The potential for higher returns is a compelling reason to invest, especially if you have a longer investment horizon and a higher risk tolerance. However, always keep in mind that investing in the financial market comes with risk. And are these risks suitable to you? Are you going to be able to sleep at night with these risks? So ultimately, when comparing the potential gains from investing with the interest rate saved by paying down your mortgage, it's essential to consider the return on your investment.
Can you just give us a concrete example of what you said?
Yes, with great pleasure, Simon. For instance, if your investment return exceed your mortgage interest rate after accounting for any fees that you may have on these investments and the taxes that you may have to pay if the investment are not in a registered or tax-free account, investing then might be the better option. Conversely, if your mortgage interest rate is higher than your investment returns after accounting for any fees or tax implications, then paying off your mortgage could be the more better option. In conclusion, choosing between the two, between paying off your mortgage early and investing is another personal decision that depends on your financial situation and goals. So as usual, I'm going to refer you to your financial advisor to discuss this and to make sure that you take the proper decision that suits your financial needs.
You're so right, Andrée. What a great subject to discuss with your advisor. So thank you, Andrée, for your explanations. And I hope you all enjoy today's program and join us again for our next edition of Property Perspective. Thank you.